Hello everyone. Welcome all of you to Tutor Online. So today we will be discussing about another topic which is related to finance, which is derivatives. So let's begin. So what is a derivative? So it is a financial instrument where the value of it depends on or derives from the value of another variable. So in a derivative, the value of the derivative or the financial instrument will be decided based on a value of another variable. So what are the examples for derivatives? Forwards, futures, options, and swaps. So we will be discussing about each of these derivatives in detail in the later slides. And another thing that we need to know is that when it comes to derivative markets, so derivatives are traded in main two markets, which are called exchange traded markets and over the counter market. So exchange traded market is where the transaction happens through an organized market. So these exchange traded markets are more standardized, right? And when it comes to over the counter market, in that market, there will be a direct contact with the other counterparty. So this over the counter market is more like a personal private agreement. So for example, let's say you want to enter into a forward agreement and then you go to the bank and through the counter, you just say that you want to enter into a forward contract. So that is called over the counter market. So there is no much of a credit risk involved. There is a high credit risk in over the counter because you are directly going and asking for the financial or the derivative instrument. But in exchange traded market, it is happening through an exchange, so that the credit risk will be much lower compared to over-the-counter markets. Right. So first, we'll talk about forward contracts. So forward contracts is an agreement to buy or sell an asset at a certain future time for a certain price known as the delivery price. So this is one of the most famous derivative instruments because this is happening over the counter. So like I mentioned before, you can just, if you are going to the bank, you can ask over the counter and say that you want to go into a forward agreement or a forward contract, but it's not that simple. There are different guidelines that you have to be adhered to, and there are different eligibility criteria as well. So in a forward contract, what you basically do is you agree to buy a particular asset or maybe sell a particular asset in a future period, right? At a price that you agree now. So the main reason why you are doing this is to hedge the risk or, to minimize the risk, because at the time you are going to buy or sell that asset, the price might have either go up or go down. So in order to get rid of that risk of the price, what you do is you just fix the price now. If you are going to buy an asset, you fix the price now, and at that date, when the maturity date comes, you have to buy the asset at that agreed price. You can't say that even though if it's favorable or not, you have to adhere to the price that you agreed, and you have to buy the asset at that price. The same applicable if you are going to sell an asset. If you agree to a certain price, you have to sell the asset at that price. So there are two main words that you have to remember when it comes to forward contracts. That's long forward position and short forward position. So long forward position is the word that is given if you are going to buy an underlying asset, or you are agreeing to buy an underlying asset in the future. That's called long forward. And short forward means if you are agreeing to sell an underlying asset in the future. So those two are kind of two main words that you have to remember when you are dealing with these forward contracts. Okay, now let's see the payoffs from forward contracts. So if we discuss about the payoffs from forward contracts, what you have to remember is that, so if the person is going for a long position, that means agreeing to buy an asset in the future. right? So if you are going to buy an asset in the future, so look at this graph. If this is the payoff and this is the price at maturity, and this can be the price that you agree to buy in the future, which is called the strike price, right? So let's say you are buying this particular asset in the future where the actual value is 0, but you are buying at a high price, which means this part over here represents what? It's a loss because you are paying a high price for an asset which is not actually that much worth, right? So you are paying a higher amount than its actual worth. And in this situation, when it comes to short position, if this is the strike price or the price that you agree to sell in the future, um, so you are selling at a high price, which is having a 0 value, which means this part over here represent a profit, right? So what you have to mainly remember is that in a forward contract, you might either end up in a loss or you might either end up in a gain, right? It's up to you, but uh, the thing is that in forward contracts, you mainly focus on minimizing your risk or hedging the risk. You might end up with a profit or a loss. So if you look at this example, let's say a company has 2 million, has to pay 2 million in 6 months and wants to hedge against the exchange rate fluctuations. So the 6 months forward rate, so they are agreeing to this rate where the buying price is 320 rupees per dollar and the selling price by the bank is 330 rupees per dollar. These are basically bank rates. These are the rates given by the bank. Explain how the company can hedge the risk of exchange. So when the company is going to hedge the risk, what do they have to do? So here they have to pay 2 million in 6 months time, which means that they have to pay 2 million in 6 months time means what? They have to have 2 million in 6 months time. So to have 2 million in 6 months time, what they have to do is they have to in 6 months time, they want to have $2 million, right? So to have $2 million in 6 months time, what should be the hedging position or the hedging strategy that they have to follow is they have to go for a long forward contract. They have to go for a long forward contract. That means they should fix the price now to buy in the future, right? Because they need to have this 320 is the bank buy rate and this 330 is the bank sell rate. So what you have to do is you have to buy from the bank now. So in order to buy from the bank, that means from the bank's point of view, they are selling. So you are buying means from the bank point of view, they are selling. So since you are buying, this 330 is the rate that is applicable. So when you're finding the total cost, 2 million into 330, you will get the total cost as 660 million, right? So what if this rate was 320 rupees per dollar? So now you are agreeing to buy in the future at a price of 330 per dollar, right? 330 rupees per dollar. What if the price at that particular time, the actual price in the market, which is 320 rupees per dollar? Then at that situation, you are actually losing. Why you are losing? Because you could have buy at 320, but since you agreed to buy at 330, you have to adhere to that price and you have to buy at 330. But in the market, it's actually 320. So which means you are losing. But what if the market rate at that particular time is 340 rupees per dollar? So if that is the case, you are actually gaining because you are buying at 330. If you had to buy from the market, you have to buy at 340, which is higher than 330. So you are at a gain, right? And so that's about the forward contracts. So now let's look at the futures contracts. So futures contract is also similar to forwards contract. It's an agreement between two parties to buy or sell an asset at a certain time in the future for a certain price. The definition is very similar to the forwards contract. The only difference is that not the only difference, that the main difference in futures contract is that the exact delivery date is not specified, and also futures contracts are exchange traded. Futures contracts are exchange traded, but forward contracts are over the counter, but futures contracts are exchange traded, where the transaction is happening through an exchange. So because of that, in futures contracts, the credit risk will be very minimum compared to forward contract. So let's see some differences between the forward and the futures. So if we look at the forward contracts, as I mentioned before, they are traded on over-the-counter market, right? So they are more like personal private agreements. But futures contracts, they are exchange traded. So since they are exchange traded, they have a very less credit risk, or we can say no credit risk in futures contracts. But in forwards, there are some credit risks because they are more personal private agreements, and it's not standardized like in futures. So forwards are not standardized, but futures are standardized. And forwards, there is a specific delivery date, but in futures, there are range of delivery dates. And forwards are settled at the end of the contract, but futures, there are daily settlements happening in the futures contract, but forward contracts are settled at the end of the contract, or basically at the maturity of the contract. So that's all about the derivative, forwards and futures. So in the next couple of videos, we will be talking about options and swaps. Thank you so much.